let's break this down. There are basically three forms on which doctors get paid. They get paid on a W-2, on a 1099, or on a K-1. If you're paid on a W-2, you are an employee. You're an employee of the company. Okay, that means that the employer provides benefits such as a 401k, health insurance, maybe some disability and life insurance. They pay half of your payroll taxes. Payroll taxes are Medicare and Social Security, and you're an employee. Okay, if you are paid on a 1099, you're an independent contractor. You are in business for yourself. You own a business. Now, you can make that a corporation. You can make that an LLC. If you do nothing, it is a sole proprietorship. That means you fill out a Schedule C on your tax form every year. You will also be filing a Schedule SE, which is for self-employment taxes. Self-employment taxes are your payroll taxes that would have been withheld by your employer if you'd been an employee, but as a 1099, they just pay you everything, and you have to pay the payroll taxes. And the way you do that is via Schedule SE. They're called self-employment taxes. Okay, so that's a 1099. If you work at 6 different hospitals, right, they're basically like 6 clients for your business. It's one business, right? And your business is your name, probably, unless you come up with a business name or an LLC name or something like that, which I don't think doctors really have to do if they're just doing clinical work. That LLC does not protect you from medical malpractice in any way. So sole proprietorship is fine. If you have a bunch of employees or other business-related liability besides malpractice, maybe it's worth forming an LLC or a corporation. But for most docs doing 1099 work, it's fine to just be a sole proprietorship. Okay, if you are paid on a K-1, you are a partner. The business entity is a partnership and you are one of the partners. So when you do a partnership tax return, when the partnership does the tax return, that is Form 1065. And part of that return is Schedule K. And from Schedule K, they take everything on Schedule K and divide it up by the partners according to their percentage of ownership and send each partner a K-1. That's where the Form K-1 comes from. So a partner is self-employed, but they are not in business by themselves. So it's not exactly the same as a 1099. In most partnerships, you will still have to buy all of your own benefits. But if you want to use a 401k, you've got to use their 401k. You can't go start a solo 401k like you could if you're an independent contractor. Likewise, the partnership often offers a health insurance plan. And so if you want to use that partnership plan, that is an option. If you want to go buy it on the open market, you can also do that. There is a way that you can still manage to deduct that, by the way. But, as far as the K-1 goes, you're not only going to be paying your own benefits, you are also going to be paying your own self-employment taxes. So your own Medicare and Social Security taxes. Again, that happens on Form SE of your tax return. But you don't file a Schedule C when you are a partner paid on a K-1. As a general rule, I'm a big fan of ownership. I like owning your job. I like when doctors have control over their jobs. I think it leads to less burnout. I think in the long run, although they have to work harder and take a little bit more risk, I think in the long run, they generally come out ahead financially. So I think this is a good thing, but it is more complex. You got to make sure that you're sending in your quarterly estimated tax payments, just like a 1099 independent contractor would. Nobody's withholding tax for you. And of course, you're going to have to pay both halves of the Social Security tax. So if someone offers you the same amount of money as a 1099 or K-1 as a W-2 employee, you're probably better off taking the W-2 employee because your expenses will be lower. But generally, they will pay you more on a 1099 or a K-1 than they will on a W-2. And if they're paying you, 10% or so more, you're going to be, equal or better using the 1099 or K-1 tax treatment. So your tax implications, you got to pay both halves of Social Security taxes and Medicare taxes. You've got to, withhold your own taxes by sending in quarterly estimated tax payments. And you can deduct any unreimbursed business expenses from the partnership against that partnership income. That's about all the tax implications of being on Form K-1.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.